Hello everyone, and welcome to ACECRT's 2017 Q2 Quarterly Market Series. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A box on your console. At the end of the webinar, we will take the time to go through these together. Third, there are several widgets at the bottom of your screen: a Contact Us link for any plan or retirement-related questions, a Refer a Friend link, and resource list, which contains helpful documents and links for your reference. There you will also find the slide deck for this presentation. Additionally, there will be polling questions throughout today's webinar. All results are anonymous, and we appreciate your participation. Now, I'd like to introduce Benchmark's Director of Investments, Ronnie Cox. As the head of the investment research team, Ronnie is responsible for managing the investment research and analytics for the Benchmark network. Ronnie has been with Benchmark for 6 years and has worked with participants, employers, plan advisors, and economists. He graduated from the University of California at Santa Barbara with a bachelor's degree in business economics and a minor in technology management. Ronnie holds a Series 7 and 66 registrations and earned the Certified Fund Specialist and Chartered Retirement Plan Specialist designations. Thanks so much for presenting, Ronnie. Now I'll turn it over to you.
Thanks, Renata, and thanks to everyone that joined the call today. As Renata said, my name is Ronnie Cox, and I'm the head of the investment research group here at Benchmark. And today I wanted to spend some time to look back at what happened last quarter, both in the financial markets as well as the overall economy. From there, I wanted to give a brief outlook on what we're seeing ahead and then open it up to any questions that you may have. So let's get started with the financial markets overview. And before we jump in, I wanted to mention that we will have a couple polling questions sprinkled in throughout the webinar today. And we're going to start off with our first question here. Which asset class was the best performer in Q1 of 2017? Emerging markets, U.S. large cap equity, U.S. small cap equity, high yield bonds, or commodities? So we'll give about 15 to 20 seconds for responses, and then we'll go to the results. All right. If you answered emerging markets, you are correct. It looks like about half answered U.S. large cap equity. We'll get into the emerging markets in a bit, but I wanted to jump into domestic equity first. So, riding the momentum following the presidential elections, stocks surged for much of the first quarter of 2017. Buoyed by the anticipation of tax cuts and policies favorable to domestic businesses, the benchmark indices listed here reached historic highs throughout the quarter. At the end of January, the Dow reached the 20,000 mark for the first time, while the tech-heavy NASDAQ gained almost 4.5% for the month. The trend continued in February as stocks posted solid monthly gains. The Dow closed the month with a run of 12 consecutive daily closings that reached all-time highs, and the S&P 500 also achieved a milestone of 50 consecutive trading sessions without a daily swing of more than 1%. At the close of trading in February, each of the benchmark indices listed here posted year-to-date gains led by the NASDAQ, which was up over 8%. March began with a bang but ended with a bit of a whimper. The Dow closed the first week of the month at over 21,000, while the NASDAQ gained over 9% year-to-date. However, energy stocks slipped as the price of oil began to fall, and entering mid-March, investors exercised caution pending the potential Fed interest rate hike and the push for a new healthcare law. For the quarter, each of the indices listed here posted impressive gains over their fourth quarter closing values. The NASDAQ climbed the most, followed by the S&P 500, which achieved its largest quarterly gain in almost 2 years. Now onto fixed income. Long-term bond prices increased in the first quarter, with the yield on the 10-year treasuries falling 6 basis points. For the second time in 3 months, the Federal Reserve increased its benchmark interest rate a quarter point amid rising confidence that the economy is poised for more growth. The move, which was widely anticipated by financial markets, takes the Fed funds rate to a target range of 0.75% to 1% and sets the Fed on a likely path of regular hikes ahead, with most economists projecting 2 more rate hikes this year. For the quarter, the high-yield bond sector was the best performing sector, driven primarily by improved conditions in the energy industry. And lastly, to wrap up financial markets, we look at international equities. A relatively positive stream of Eurozone economic data helped international stocks post gains for February. Both manufacturing and service sectors accelerated during the month, while Eurozone job creation reached a 10-year high. In Great Britain, Prime Minister Theresa May continued to push forward with Brexit amid pushback from Parliament and protesters. Nevertheless, the UK delivered written notice to the President of the European Union, formally beginning the process of leaving the EU, also known as invoking Article 50. This action now opens up a 2-year window for Britain to negotiate the terms of its exit. One of the potentially contentious issues that will be addressed is whether and how much Britain will pay to leave the bloc. In Japan, retail sales increased 1% for the month, although the fourth quarter GDP growth slowed from the previous quarter. Emerging market stocks advanced in the first 3 months of 2017, recording the strongest first quarter performance since 2012. Firming economic data in Asia and diminished concerns over potential U.S. trade policy helped lift the emerging market equities. Emerging market currencies generally gained against the U.S. dollar over the quarter, as waning confidence in the ability of the U.S. government to stimulate growth or impose trade sanctions led investors to adopt a weaker view on the U.S. dollar. Next up is our look at the U.S. economy, and this brings us to our second polling question for the day. Out of the last 11 economic expansions, where does our current expansion rank in terms of length? First, third, fifth, or seventh longest? All right, we'll just give a couple more seconds. And we'll go to the results. So it looks like most people answered third longest. And as a matter of fact, March 2017 marked the 93rd month of our current economic expansion, making it the third longest expansion in the last 60 years. Since the current economic expansion has passed beyond 93 months, while the average economic expansion has averaged 47 months, many feel that we're heading towards a recession based on timing alone. While concerns like these are reasonable after over 6 years of economic expansion, I do want to highlight the more gradual pace in which this expansion has moved, as shown by the light blue line in the chart on the right. Economic expansions have generally been getting longer as the service sector, which is a relatively more stable sector of the economy, makes up a higher percentage of GDP than the manufacturing sector. This more stable growth may provide more structural support for continued economic expansion moving forward. Looking at GDP, expansion of the U.S. economy slowed over the final 3 months of 2016. According to the Bureau of Economic Analysis, the fourth quarter of 2016 gross domestic product grew at an annualized rate of 2.1%, compared to the third quarter GDP, which grew at an annual rate of 3.5%. Growth in GDP was slowed by downturns in exports, federal government spending, and business investment. A positive from the report is the rise in consumer spending, which increased 3.5% over the prior quarter. An indicator of inflationary trends, the price index for gross domestic purchases increased 2% in the fourth quarter, compared to an increase of 1.5% in the third quarter. As to the government's budget, the federal deficit for February was $192 billion, while over the first 5 months of the fiscal year, the deficit sits at $385 billion, which is 0.7% below the same period last year. Next is the employment situation. The economy continued to show strength as it averaged adding 178,000 new jobs per month last quarter. Job gains occurred in construction, private educational services, manufacturing, healthcare, and mining. The unemployment rate dipped to 4.5%, down from 5% a year earlier. There were 7.2 million people identified as unemployed in March, and the labor participation rate inched up 0.1% to 63.0%. The average work week was relatively unchanged at 34.3 hours in March compared to 34.4 a year earlier. Average hourly earnings increased to $26.14, and over the last 12 months, average hourly earnings have risen by 68 cents or 2.7%. And lastly, for the economic overview, we look at the Consumer Price Index. Inflation, or headline inflation, as measured by personal consumption expenditures, reached the Fed's 2.0% annual target in February. For the 12 months ended in March 2017, personal consumption expenditures expanded at a rate of 2.4%, where core PCE, which excludes energy and food, increased 2%. For the 2016 calendar year, personal income increased 3.6% from the 2015 annual level, compared with an increase of 4.4% in the previous year. Disposable personal income, or after-tax income, increased 3.9% in 2016 compared to 3.8% in 2015. Personal income and spending data through March 2017 will be released on May 1st and can actually be found, if anyone's interested in looking at it, through the Bureau of Labor Statistics website, which we provided in the resources widget on the screen. And for my final comments, I wanted to provide an outlook for the coming months and year. But before we get to that, I wanted to ask one last question for the day. This question does not have a right or wrong answer, and if you attended this webinar last quarter, this question probably looks familiar to you. The question is, how do you feel about the outlook for the economy in 2017? Not confident, neutral, confident, or very confident. So again, we'll give a few seconds for people to respond, and we'll go to the results. All right, it looks like we got a lot of responses, and a majority of people responded confident. So as I was reviewing the slide and coming up with themes this quarter, looking ahead for the rest of 2017, I looked back at what we had talked about in the previous quarter, and I think a lot of this still holds. I think rising populism is still a lot of what we're hearing about in the news and a lot of in the front of people's minds with the current Trump administration, with the recent elections in the Netherlands and the upcoming elections in France and Germany. We still have a focus on slow growth to inflation. We hear a lot about potential and current deregulation occurring with the Trump administration, as well as this move from monetary policy to fiscal policy as the Fed starts to tighten, and we see Congress and the executive branch talk about potential tax reform. All that said, I think there was one big theme that I wanted to add for this quarter, and that's geopolitical events. So we're seeing a lot more in the news about the strikes in Syria and the bomb that we dropped in Afghanistan, rising tensions with North Korea, and how China may play a part in that. So I think as those headlines become more front of mind for investors, that's something to be aware of moving forward in 2017. All that said, we're still in a very transitory period where we're moving from globalism to potential populism, where we're starting to see inflation start to pick back up. We're moving from a more regulatory environment to deregulation, and from monetary policy to fiscal policy. So while the pro-growth prospects for 2017 are a positive sign, given some of these themes, it's not without risk. With increased political tensions, and the potential for the Trump administration to start a trade war with various countries, the levels of uncertainty do appear to increase in 2017. So with that said, I'd like to end my comments on this slide, which will look familiar to those of you who attended the webinar last quarter. This slide represents the annual returns of various asset classes for the last 10 years, with the sample asset allocation denoted in the blue box with the orange star. While it's difficult for even the most experienced economists and market experts to predict how the markets will behave in the next 6 to 12 months, it's always important to keep in mind a long-term focus for your retirement plan. While the asset allocation displayed in the table has never been the top performing asset class in the last 10 years, it's never been the worst performing either. Keeping an appropriate asset allocation based on your particular circumstances is an important factor to keep in mind with your retirement plan. And that wraps up my comments, but before I turn it over to Renata for Q&A, I just wanted to mention at the end of the webinar, there will be a couple of survey questions. We really want to get your feedback in terms of if there's specific things that you want to hear about in regards to the market and economy for next quarter, as well as particular topics that we present on this webinar series. So with that said, I'll turn it over to Renata for questions.
Yeah, thank you so much, Ronnie. We really appreciate you sharing your time and knowledge here with everyone today. As you mentioned, we'll start addressing some of the questions that have been filtering in. Attendees, please remember that you are able to submit any of your questions in the Q&A tool on the webinar console. And as always, you can reach out to your dedicated service team at the ACEC Financial Wellness Center for any plan-specific questions. So our first question here today is, you touched on geopolitical events affecting the economy. Could you possibly elaborate on that?
Yeah, and I think a good example of this, if any remembers back in 2010, 2012, there was a lot of geopolitical events happening at that time, particularly what was called the Arab Spring. And what we saw in the markets was there was a lot of market movement based on big headline news and not necessarily underlying fundamental changes. And I think we're starting to see a bit of that creep back in. We saw yesterday and earlier this week, a couple things happened. We had Theresa May, the Prime Minister of the UK, announced that they were going to hold a snap general election as opposed to waiting until 2020 for that elections, and so that shocked markets a little bit. We had Goldman Sachs reporting earnings earlier this week. They missed earnings estimates, and what was noted in their announcement was their outlook has diminished a little bit looking forward in 2017, and they specifically cite geopolitical risks with news about tensions between North Korea and Russia, our relationship with China, and the ongoing civil war in Syria. There's a lot, I think, that investors should be aware about. But with that said, I think it's important to keep in mind your risk tolerance, your asset allocation, and keeping a long-term focus on that. So your retirement plan is set up for long-term investing. And I would encourage everyone to reach out if you're unsure if you're appropriately allocated or diversified, to reach out to the ACEC Financial Wellness Center, talk to a licensed rep to really consult on your particular situation. They can walk you through a questionnaire and really give you some insight on how someone might allocate based on particular circumstances. But great question.
Great, thank you. Now, what kind of markets or industries should we keep on our radar?
In terms of industries, and I don't want this to come across in terms of what industries I think are going to outperform or underperform for a certain time period, because I want to make it clear I'm not trying to give any investment advice to a particular industry. But I do want to point out a couple industries that I think are going to be noteworthy this year, whether there's positive or negative things happening within those industries in the next 12 to 18 months. or there's a lot of news and noise around these industries. So one, and I think one of the biggest ones is going to be healthcare, because we've seen Congress trying to introduce legislation to repeal and replace the Affordable Care Act. We saw that initially fail. It's unsure if something's going to happen with that. In the near term, it sounds like the Republican Congresses and the Trump administration want to get something done, but I think regardless, there's going to be a lot of friction and noise around the healthcare industry because of that. The second one, I think, is the energy industry, particularly oil, with the volatility in prices that we've seen in 2015 and 2016 and into this year, coupled with the deregulation that the Trump administration has talked about, and some that they've already issued executive orders on. Others they're talking about really freeing up the energy industry to do business as they wish. And the last industry I would point out is financials. And again, I think there's a couple factors at play here. One is with the Federal Reserve potentially raising rates possibly another 2 times this year. That could be a boon for the financial industry, but there's also legislation or talks of legislation in Congress, kind of from both sides, whether it's repealing or removing certain provisions of the Dodd-Frank Act, which was enacted after the 2008 financial crisis, or another piece of legislation that legislators are calling the 21st Century Glass-Steagall, which may impose certain other regulations on financial services companies. So I think there's going to be a lot of noise and news, particularly in those 3 industries moving forward. So it's something to keep an eye out.
Thank you, Ronnie. And could you elaborate on how shifts from monetary policy to fiscal policy can affect the economy and markets?
Yeah, so, and just to back up for a second, monetary policy is really driven by the Federal Reserve in how they loosen or tighten interest rates, how freely money can move around in the market, and they really hold the power in terms of monetary policy. Fiscal policy, what I'm talking about, is really ultimately comes down to tax reform. And I know it's been talked about a lot with the Trump administration and Congress after the failed health care proposal that they introduced earlier this year. They said that they were going to shift towards possible tax reform. Originally, the Treasury Secretary said that they were aiming to have tax reform done within the first 12 months, and within the past week, he's now pushed that expectation back a little bit. So while I think it's still coming, it's I think slower moving than what the administration originally proposed or would have hoped for. That said, what they're talking about with tax reform is lower taxes for corporations, a simplified tax code that could potentially bring in more money. And the idea is if we're freeing up and having a lower global tax rate, there's a lot of money that's sitting overseas that corporations may bring back that may spur economic growth. If companies are paying lower taxes, they may be hiring more, which could further spur economic growth. It's just a matter of what proposals are going to make it through both houses of Congress and ultimately signed by the president. So it's something to keep an eye out for. Again, there's a lot of uncertainty around it, but definitely going to be a big news item in the next 12 to 18 months.
Great. So I think that concludes the questions that have filtered in. Thank you so much, attendees, for your participation, and thank you, Ronnie, for taking the time to present to us today. I encourage you to use the contact button on the webinar console if you have any more questions regarding the webinar or any plan-related questions about your retirement account. I hope everyone has a great day, and we look forward to seeing you on our next webinar series. Thank you so much, and take care.